The key economic data out this week obviously has to be on the international front. The US, the Federal Reserve, interest rates are lower for longer, and we are seeing QE2, as everybody is referring to.
No, exactly. I think that was the thing that rattled the market quite clearly, and may continue to do so. And I think the big thing is that we've now gone through the earnings season. And this is what's happening with the market, is that earnings come out, that dominates the news, the shares go up. Then comes the macro environment, and then the shares start to come down again. And so with the earnings season behind us and the macro season basically back in vogue, we may well see a patch of weakness on the market as we go forward with this. It wasn't really a fabulously pretty picture. There was some mixed signals.
But this week comes on the back of a week where PMI numbers were looking much better, and everybody was excited the week before that everything was on track.
Everything was on track, and then we see the data. And this is the problem, is that the data is patchy. And of course this is what vexes the analysts. Do we see, is this a sign of a double dip, or is this just a natural slowdown in momentum in a recovery cycle?
And what do you think?
I'm in the double dip camp, unfortunately, or whatever. I just feel that when you've had interest rates and the amount of liquidity that's been pushed into the system for such an extended period of time, is that we would have seen a stronger recovery by now, and we wouldn't see such a rollover in the actual momentum of that.
Because at the moment the recovery hinges on an artificial boost in terms of all the money that has been piled into the system.
A lot of it's been statistical, in other words, inventory recoveries, etc., rather than a fundamental resurgence in final demand in the economy, and that is a concern. And I think this is going to be interesting to see what's happening, but I think whenever I look at analysis saying, no, this is actually just a hiccup, right? And it's a natural thing that you see the downturn and then the up, that carries on afterwards. Most of that kind of analysis, and it's a cyclical analysis, and what we've experienced time and time again in the past, will always ignore the debt. And that might be where the problem is that the Japanese scenario also had a down dip, but they never recovered because the debt was just too much. Does
that mean that global markets are never going to recover from these levels? Because if you use the Japanese analogy, that's where we're trending.
Never is always a bad word to use in markets, but we are seeing a decoupling, right, between the developed world and emerging markets. And I know decoupling is one of those swear words, etc., but the end of the day is that you can see the correlation. The correlation is so strong between global markets, but the decoupling is there. So you can see the outperformance that is occurring.
But emerging markets aren't going to continue to outperform if we see a dramatic slowdown in the developed world. We're too reliant for our growth on them.
Not at all. Effectively, you're starting to already see in this rebound, for instance, in things like industrial production, Brazil, China, India, have already reached the pre-crisis levels and gone beyond, whereas Europe, US, UK, Japan haven't even recovered half, or virtually just half the losses in things like industrial production, retail sales, etc., of the pre-crisis levels. So you're already seeing in that area that the market share, for instance, of industrial production is still shifting towards the emerging markets. And I think what's also happening is that you've got a lot of internal a shift to an internal thing. So what I'm saying, if you see a double dip in the US and the like, you'll see a slowdown in emerging markets, but it won't be a double dip. It won't go into recession. It'll just be slower growth, for instance. And that's how I think you'll see that divergence taking place.
Just looking at the local front, we had manufacturing output rising 8.8% year on year in June. Not to forget that it's off a very low base, so we shouldn't get too excited about this number, should we?
There's the low base, there's the PMIs, which is not looking as healthy.
The Kagiso PMI below 50.
Exactly, that's below 50, which suggests in the months ahead that'll also lose momentum. And the big thing that's really been dominating South Africa this past week is the industrial action. And I think it comes at such a poor time, in the sense that the public service strike just seems to be pointless. If we do go into strike action, and we already had the one-day stowaway, it seems to be such a narrow difference at this stage, especially on the thing. It's not that wide. And then the mud industry strike was something that really disappointed. You know, in the wake of the World Cup, you know, that's the marketing exercise. The marketing was
Motor
successful.
industry looking for a 15% increase across the board.
15, it's almost like they're starting off with strike action instead of negotiating first and maybe culminating in that. And that hostile labour, hostile regulations, rising tax levels, those are the things investors don't want to see. And when you've had a successful marketing campaign, at least our product starts to look good, but we're not doing that.